Good day. Welcome back to my channel. This is Edge Out, and please do click the subscribe button if you like our financial management course here in YouTube. Yesterday, I learned from the news that the Commission on Higher Education is pushing blended online and offline learning after this lockdown. So perhaps this delivery of instruction will be in for the coming months. Hopefully becomes the new normal, as they say. Anyway, some of my friends are asking me why edge out. Well, it's actually a corporate term of gradually edging out the competition, slowly becoming more successful and popular. This is the new trend, so we all have to adapt to these changes in order to be competitive enough. But I think I need more training for the improvement of the video effects, maybe soon. Nonetheless, my concern here is to deliver our topic, which we are now on the functions of corporate financial management. This is more of an MBA thing, but for education, I believe that under educational planning and management, this course is as important as managing curriculum development, as this involves the feasibility of the growth of an educational institution, especially those private schools. As an introductory, I will bring you to the areas of finance. Corporate finance relates to the functions of a financial manager or finance officer in your organization. Public finance deals with the utilization of government funds. Investment finance entails choosing the right combination of your financial asset portfolio. Well, obviously, those who are in banks understand better the dynamics of banking and monetary policy. Personal finance, on the other hand, is the expertise of entrepreneurs and financial advisors. And international finance, moreover, has wider scope that explains foreign direct investments and currency exchange rates. What is corporate financial management? This refers to the career in finance that focuses its activities to the wealth maximization of a private company or business. As there are many possibilities in the practice of financial management profession, this course is specifically concentrated on how to manage the funds of a corporation, including nonprofit organizations like educational institutions. Here is our outline, and we will take this one by one for you to understand and appreciate the tasks expected from a financial manager. You may not all be designated as the finance officer, but somehow each member of the middle or top management must be able to comprehend the activities performed and decisions made by a financial manager. The financial manager acts as the money manager. His or her functions include monitoring the cash inflows and outflows on a day to day basis. As the person who knows the financial status of the firm, he or she decides for long term investment plans of the company. Therefore, it is also his or her responsibility to assess the corresponding risk of these investment opportunities. The definition of financial management revolves around acquisition, financing, and management of assets with an overall goal in mind. So it is basically about cash flow management, where to get the funds, financing, how to utilize the available funds, operating, and how to maximize the use of excess funds if there's any, investing. Of course, we will learn later on what is this overall goal in mind. As we say, we cannot forego its related fields. Accounting information as our basis in making management decisions, and economic environment. as we consider factors that may affect our decisions. Some of these factors that may be relevant to the financial manager are inflation, unemployment, industrial production, domestic and international competition, foreign trade statistics, international capital flows, exchange rates, changes in technology, consumer and investor attitudes, the state of financial markets, and changes in government policy. What is in demand today might be out in the market the next day. What is legally marketable today might be illegal tomorrow. Financial managers must always go with the latest happenings in the business world, including changes in taxation policies. So, what is really the goal of financial management? Not to have more cash in the company, of course. Remember, less cash. It's a mortal sin to maintain lots of cash in financial management. Bawal na bawal sa Chinese na natutulog ang pera. The rule is, if there's excess funds, invest. If it's insufficient for the operation, look for financing and make sure that what is left in the operations must be not too much, not too little, but just enough for the firm's needs. That is what we call maximization of shareholders' wealth. What is a shareholder and how does shareholders' wealth being measured? The shareholder is the owner of the shares issued by the company. In short, when the company generates funds through financing, investors put their money to the corporation in the form of shares. Shareholders are the investors. These shares are being sold in accordance with the rules and regulations of the financial market as authorized by the Securities and Exchange Commission. Normally, one share is sold for 100 pesos par value. When an investor buys one share, it means he puts his 100 pesos to the company. However, as the company grows and performs better, its shares will be sold at a higher price to the investors who wish to join the company late. As the company displays its potential to grow bigger, more investors will become interested in buying shares or putting their money to the company. In this case, the stock price will increase. Law of supply and demand, right? This stock price is also called the market price or the market value of the shares, meaning after using the 100 pesos for the first investor for 1 year of operation, his money might earn say 10 pesos, making his money grow to 110 pesos. While the behavior of other investors is enticed, the market might set a stock price of 120 pesos for the incoming investors to join the company. Take note that the 100 pesos is the par value. If it earns 10 pesos during the year, it is called the earnings per share. This is equivalent to the total profit earned by the company for the period divided by the number of shares issued to all shareholders. When the company gives back the 2 pesos as a return, this is now called the dividends per share. Well, the intention of the investor is to become partly owner of the company and to make the company grow, not to get the return of its entire investment immediately. No need to worry because the remaining amount still belongs to the shareholder, which is now called the book value per share of 108 pesos. What if the market price of the share has now increased to 120 pesos? Then, financial management decision should be made. Investors may buy, sell, or hold their investments. Some investors prefer companies that increase the value of their shares and at the same time give dividends, while some companies don't declare dividends, which might lead shareholders to sell their shares if they don't receive any return. It is just a matter of economic decision making. Again, the shareholders' wealth is measured based on the share price or market value, not solely on company profit, because company profit is just the earnings per share. Now, what drives the increase of the market value? It is said that the primary goal is to maximize the wealth of the company's shareholders by increasing the market value of their shares. If profit is the main target, this may conflict with social or ethical goals and interests of the management. It will be like, let us earn and earn profit, whatever it takes. However, it must be noted that the market value can be driven by other factors. The, the three-piece bottom line now expands to profit, people, and planet. With good people management, giving the appropriate compensation to employees, the company might establish goodwill. With its care for the environment, having a sustainable corporate social responsibility programs or CSR, the company may create a positive brand image to the public. Thus, the increase from 108 pesos book value and 2 pesos dividend per share to 120 pesos market value can be attributed to its good corporate governance, making the investors to be more attracted to invest in the company. Corporate social responsibility strengthens the brand image of the company. That is why many organizations now are reaching the public in these times of needs. Wealth maximization does not only limit to financial profit, but it also extends to being socially responsible. Companies should produce both private and social goods. This is the goal of shareholders' wealth maximization. To increase market price, the challenge is indeed not one time big time, but the word is sustainability. With good corporate governance, the systems and processes we implement in companies, the goal of shareholders' wealth maximization can be achieved. Take note of the role of the management as the agent of the owners or shareholders. Financial managers should act in behalf of the interest of the owners of the company. Therefore, the function of financial management is to maximize the wealth of the owners. This is actually based on the agency theory by Jensen and Meckling. Principals must provide incentives so that management acts in the principal's best interest and then monitor results. After the management performs well, the owners may give them incentives in the form of stock options, perks, and bonuses. It is also important to emphasize the relationship of return to risk. Making the company grow means taking its corresponding risk. Management can encourage an increase in share price by earning an attractive return at an acceptable level of risk. Look at here. The simple rule is the higher the risk, the higher the return. Investing in stocks might be profitable but riskier as compared to simply maintaining a safer savings account. Financial manager must choose appropriate combination of potential profit and level of risk. Now, financial managers borrow funds at lower interest or dividend at an acceptable risk and use these funds to buy company assets so as to earn profit and thus encourage more investors. If the financial manager can convince investors of its proper financial management by maximizing the usage of funds, more investors will entrust the company, providing the firm with more opportunities to grow using more investors' money. Included in financial management activities are financial statement analysis, or interpreting accounting reports to monitor and improve performance. Working capital management, which comprises the day to day activities of handling cash flows, receivables, and inventories. This is the most challenging part of doing financial management. Financial forecasting, or short term budgeting, normally done during the annual planning phase and or when cash flow projection is necessary for a project proposal. Capital budgeting or long-term investment decisions deals with the computation of return on investment and making accept or reject decisions. And financial decisions or capital structure, that the time cost of capital is analyzed, whether it is more beneficial to look for new investors or to apply loan in banks to finance a certain project. As you can see here in the figure, the daily and the occasional duties of a financial manager and its endpoint must focus on weighing trade-off between profitability and risk. How to maximize shareholders' wealth in a most profitable manner at a lower or acceptable level of risk. The rule again is the higher the risk, the higher the return. What is the level of risk tolerance in your organization? The risk taker your management is, the stressful the task of your people, as you always monitor targets and quotas. Again, don't judge the company by its profit now. We should look into its current and future earnings per share and the risk it is willing to take in the long run. The key is sustainability. As the barometer of business performance, investors are more interested about the market value or share price. Share price is variable, meaning it changes through time considering a lot of factors. Look at some of the corporate goals of companies here. They really incorporated financial management to their vision mission goals. Cadbury Schweppes, governing objective is growth in share owner value. Credit Suisse Group, achieve high customer satisfaction, maximize shareholder value, and be an employer of choice. Dow Chemical Company, maximize long-term shareholder value. ExxonMobil, long-term sustainable shareholder value. See, if your organization does not value financial management in its long-term goals, do not expect for growth. Lucky for you if you belong to government institutions. You don't need profit to grow and to be financially stable. So here is the organizational function of corporate financial management. The highest position that you can get is being the vice president for finance. Appreciate how challenging the function is. Part of the responsibilities of a financial manager to efficiently manage entity resources, to effectively mitigate risks to attain entity objectives, to maintain a sound financial condition within the limits of available resources, and to comply with applicable policies, laws, and regulations. Aside from that, the financial manager should understand the probabilities of risk to calculate the uncertainties of the decision. This may adversely affect the ability of the firm to achieve its objectives. I want you to know about the latest types of risk we commonly encounter nowadays. We may have wonderful dreams and visions for the company, but calamity risk is always there. How do we prepare? Are we aware that they are coming soon? As the world changes rapidly, a lot of new policies and regulations are being introduced. Best example would be taxation laws. Have we included in our expenses the increase of taxes to be paid or the effects of these new regulations to our consumers? You might be dreaming of a sustainable business venture, but while recovering your investment, your business might be illegal or regulated as per new government legislations. The faster a business adapts to technological advancement, the greater its potential to stay on top. However, hackers can manipulate and distort company information that might lead to business losses. How do we maintain controls for the privacy of our information? Information are company assets, aren't they? How are the values and culture of our organization? Most companies incur losses from corruption and management fraud. According to certified fraud examiners, these losses comprise at an average of 5% of the company's gross revenues. Are we aware that there are under the table transactions out there? Risks have both quantitative and qualitative factors. We should consider quantitative factors like cash or monetary losses, cost of property, equipment, or inventory, and cost of defending a lawsuit. We should also consider qualitative risk factors, such as increased legislation, loss of public trust, and injury to the entity's reputation. However, there are ways on how to deal with risk. How serious are we in considering them? We may ignore, accept, transfer, or mitigate them. Have we invested for risk? In fact, in personal finance, it is suggested that before we go into investment in any short term or long term securities, we must have a safety net first. Example, life and health insurance. Now, what are really the financial goals of a corporation? I am posing these questions for you to reflect on. Do firms have any responsibilities to society at large? Is stock price maximization good or bad for society? Should firms behave ethically? These are still issues in financial management. Erase the wrong notion that financial management is about making a company or person rich. Having more money is different from becoming sustainable. Think of that. To conclude, just like in our personal lives, the manager controls the daily ins and outs of cash. The more you challenge yourself in managing cash, the more you grow. If you just want to get relaxed about your finances, then you will continually live in a rat race. If you don't think of investing in the future because you are afraid of risk, then do not dream of expansion and success. Lastly, Don't you ever forget the rule. The higher the risk, the higher the return. Do not compare yourself to others. It's a behavioral finance thing. We have different risk tolerance. If others are successful, that's because they are risk takers. Can you force yourself to take bigger risks? Let's teach the younger generation as early as possible how to become a risk taker and how to deal with risk. This is the thing that we cannot find in the traditional educational system. Students are evaluated based on correct answers, but life is tested and endured based on wrong moves and failures. That's all for now. Thank you very much for watching Edge Out. See you in my next videos. Don't forget to like and subscribe. Bye.